Investment decision making using Excel. This video is the third in a series discussing the essentials of effective investment decision making. It discusses the benefit-cost ratio, maximum capital at risk, and payback. An important but underutilized economic analysis tool is the benefit-cost ratio, or profitability index. The benefit-cost ratio, BCR, is the present value of an investment's benefits divided by the present value of the initial cost. The benefit-cost ratio shows in an intuitive manner how much discounted money an investment will yield. For example, a project with a benefit-cost ratio of 1.5 returns $1.50 in discounted money for each $1 invested. Determining the cost that goes into the denominator of the benefit-cost ratio occasionally can prove confusing. However, the introduction of another investment analysis tool, the maximum capital at risk, MCR, simplifies the calculation while simultaneously providing additional insight. The maximum capital at risk is the present value of an investment at the point where the investment most exposes an investor to loss. The maximum capital at risk is the most negative number in the series of cumulative discounted cash flows for a project. The maximum capital at risk is not only important in itself, but it also provides a convenient means to determine the benefit-cost ratio. The formula for calculating the benefit-cost ratio is BCR equals MPV divided by MCR plus 1. Now let's look at some examples. You can find the Microsoft Excel workbook that accompanies this video at toweringskills.com/docs/FA002.XLSX. Select Example 1 on Tablet 1. We discussed much of this sheet in the prior video. However, we did not discuss cell C19. C19 calculates the maximum capital at risk, MCR, by finding the most negative cumulative discounted cash flow, which is the most negative cell in the range C15 through H15. This spreadsheet uses the MIM function, which finds the minimum value in a range and ignores logical values and text. You can also use the MINA function, which does not ignore logical values and text. Cell C20 illustrates that the benefit-cost ratio is found by dividing the net present value found at cell C17 by the maximum capital at risk found at C19 and then adding 1. Example 2 on tab 2 shows 4 projects with the maximum capital at risk, net present value, and benefit-cost ratio for each project. This example illustrates the challenging aspect of determining the maximum capital at risk by simple inspection rather than by a systematic approach. To illustrate this, the yellow highlights show the years with negative cash flows. The orange highlights show the most negative cumulative discounted cash flows, and these match the green highlighted MCR values. Project 1 is straightforward because a negative cash flow only occurs at time 0 in cell C11. Project 2 is more complex because negative cash flows occur at time 0 and in year 1 in cells C23 and D23. Project 3 falls along the same lines except that the negative cash flows occur in period 0 and period 2 in cells C20, C35, and E35. Note that the positive cash flow in year 1 in cell D35 more than offsets the negative cash flow in year 2. And Project 4 offers another variation with negative cash flows in periods 0 and 2 in cells C47 and E47. But with this example, year 1's positive cash flow, that is a positive 13.4 in cell D47, fails to fully offset year 2's value of negative 15.9 in cell E47. This type of complexity illustrates the need to automate the determination of maximum capital at risk. The method we will use first finds the cumulative discounted cash flow and then finds the minimum point on that range. This approach reliably automates the calculation. Many investors use Payback as an investment tool. Indicating the time it takes to recover an investment, Payback is easy to calculate and it provides useful information. Some investors use this as their main criteria for evaluating investments. Unfortunately, Payback fails to fully account for the time value of money. Various methods for calculating payback include starting at the point of the first investment and starting when the project begins generating revenue. Payback can either use discounted or non-discounted values. The examples accompanying this discussion employ non-discounted cash and track the time from when the project begins generating a positive cash flow. Example 3 on sheet 3, line 10, shows a project that achieves a 5-year payback as measured from time 0, or a 4-year payback as measured from the end of year 1 when the project cash flow turns positive. In this video we discuss the financial analysis tools, benefits cost ratio, maximum capital at risk, and payback. These tools go hand in hand with net present value and internal rate of return, which we discussed in the prior video. Net present value, maximum capital at risk, and benefit cost ratio all depend upon a specified interest rate or discount rate. On the other hand, internal rate of return and payback do not require a discount rate. Internal rate of return and benefit cost ratio both reflect the intensity of capital return, while the net present value is an extensive value indicating an opportunity's overall size. In the next video, we'll see how to use these tools to make investment decisions. Click here for the next video. Or to learn more, go to toweringskills.com.